Hey, what is up, guys? It's Clockyy Trades here, back out with another video. Now, I'm not a financial advisor before we begin, but this is just for entertainment purposes only, and let's get started. So this is going to be a video about what basically is an option and how you create one. So for the people that are not basically have the information or advances within options trading and stuff like that, if they had never done it before or they're just trying to get into it now, this is a video about how to basically make one and what it means as you're creating a contract. So basically in finance, this is the basic definition that an option is a contract that which conveys its owner or the holder the right but not the obligation to buy or sell an underlying asset or instrument at a specified strike price prior to or on the specific date that you choose, depending on the form of the option. Now, the people that are understanding about options, there's a lot of different forms that you can make. There's naked calls, naked puts, there's spreads, there's iron condors. There's a bunch of different things you can make within options, a bunch of different forms you can do. You can sell covered calls, you can also do cash secured puts. Now, basically, when you create an option, anything within options, it's times 100 shares or anything like that. It's just times 100 because it's like 100 shares. So if I can give you an example for that, let's just go to TNA for example. It's trading at 38.91. If I want to click trade options, TNA options, and if I buy a call, I'm buying a call. So that means basically when you buy a call, you are betting that a stock's going to go up, right? If by its expiration date, you're gonna say, let's just say it's gonna go up by to $40 or just up in general. So, but when you buy this contract, it's gonna cost you $87 because times 100, because it cost me 87 cents or 84 cents a share times 100, which will be $84. So that would be a maximum cost of $84 for this contract specifically for this expiration date. Now, there's also the Greeks, which you can learn as well about, and basically you can make per dollar or you can lose throughout the day. So this is you're basically losing, I think, $15 if I'm correct. You lose 15 or $16 a day just for holding this contract till the expiration date. Now, this is pretty cool and all because it's not the best way to make money within options because, like I said, you lose money daily just from theta decay alone, and this is very close to expiration date. So I would not do this. But for an example, this is what it does and how to create an option. You're basically betting that a stock's going to go up to a certain price by that expiration date. But you don't want to hold on to this expiration date is because buying a call, buying a naked call, a long call, you lose money daily. So it has to move up a good, more than what it loses a day. So that's basically what a buying a call is. Buying a put is the opposite. You're betting that stock's going to go down. So it'll cost you $75 for you to think it's going to go down to $37 by Friday. Now, you never really want to buy short-term contracts in general, or at least when you're buying. I personally don't buy contracts because you lose money daily and it's very risky to do. You have a 50-50 chance basically if it goes up or down that day, or it just stagnates. It just doesn't move at all, and you lose money. Now, with selling calls or selling puts, for example, you are betting. Same thing. Everything's betting. It's all the stock market. So you're basically saying when you sell a call, you get a premium. So on the side, each time it goes, the further you go down means the safer you are because it takes long or it takes more for the price to drop to that number. So each number on the side has a strike price, and when you do this, you have to have times 100. Of collateral because you're selling a put. I mean, you're selling a put, so that's basically saying that you're betting a stock's not going to go down at a certain point, and you have to have collateral for that 100 shares at that strike price over here that you choose. So let's just say I want to be quote unquote safe, and I would need $3,500 to make $34 minimum credit instantly into my account. So if I hit review, so I would need $3,500 to make $34. But I'm safe because in case it does go below $35 by this expiration date, you get to keep this $34, but your collateral will now turn into 100 shares at $35 a price that $35 when you bought it, but basically it could be at $34. So you could be down $1 per share times 100. So you could be down, but you never lost anything. So basically, if you sell, let's just say this exercises, and you are forced to buy a 3,500 worth of TNA at $35 per share, and it's at $34. Well, if you sold after that exercise, then yes, you lose money. But if you just wait and it goes back up and then sell, then you're profit either way. But then in case that does happen, you can now sell calls. So selling calls is basically the opposite. If you want to sell calls and you think the stock is not going to go up to $42, let's just say, by this Friday, well, then you'll get a minimum credit of $32, but you'll need that 100 shares. So like I said, this is just called the wheel strategy. A lot of people know it within options trading, the stock market, Robinhood in general. They know this is called the wheel strategy, and you need a lot more capital to do this, but this is basically the safest, quote unquote safest way. Like I said, I'm not a financial advisor, but this is the safest way, in my opinion, that if you have a large amounts of capital, that this is what you could do to make extra side income on the side as quote unquote passive income. Now, you don't really want to rely on this for, consistent passive income, but this can always be a little bit of money that you can be bringing in a little bit to, pay for groceries or buy something. But there's a bunch of different things you can make within options. Now, if you guys have any questions, this is basically the gist of it. If you have any questions, just let me know. I'll be streaming hopefully one of these days with when the stock market's open during the day. And if you guys want to ask me questions in real time, I can answer them as well. Now, there's a lot. If you want me to make more videos about spreads and the way and the reason why I do them and which ones I do, like right now I have a bunch of credit spreads which I'm holding my portfolio. This is what I'm doing. So basically the week I'm still down 3.77% for the week. That's because I closed all my positions last week and then I made new ones, and of course this week it decides to have a correction. So yeah, that's basically what I have right now in my portfolio. That's something about spreads. Well, I have credit spreads, so we'll put credit spreads to be exact. But yeah, this is what my portfolio is. And if you guys have any questions, let me know in the comments down below. Don't forget to like and subscribe. As always, it really means a lot to me. And I'll see you guys in the next one. Peace.